So today I'm going to talk about investing briefly, just give a basic introduction to investing. Now, why do people invest? There's two reasons. Reason one is that cash loses value. Now, I'm sure you've heard of inflation, and what that is basically the value of money goes down over time. Things cost more over time. The dollar has lost about 97% of its value since the year 1900. This is called, this is the inflation, right? I'm sure you've noticed over time that things go up in price, they get more expensive. And when you invest, you grow your money. A savings account in this low interest environment, it doesn't really return much. So you're still losing purchasing power to inflation. But if you invest in stocks, bonds, real estate, they generally tend to outpace inflation, and you have more money than if you would if you just kept your money in cash. The second reason, if you don't find a way to make money while you sleep, you will work until you die. If you invest, it's possible to amass enough investments to produce enough passive income so you don't have to work if you can't or don't want to. And it's actually possible, and I'll talk about this in a different video, it's possible to accumulate enough wealth that you can retire decades ahead of schedule, like the normal retirement age of 65. So there have been people that retired at 30, 40, 50, and it's very possible for most people to do that. Now, before you start investing, this is very important. You have to get out of debt. Debt is a financial freedom killer. It's a drain on your finances. Not only are you having to pay back something you bought when you didn't have the money, which reduces your current income because you're paying for it with current dollars for something you already consumed, right? But you also have to pay interest on top of that, and that further reduces your current income, right? Having debt is like trying to row upstream. A lot of your effort is being stolen by the current. It's the same thing with interest. It robs you. If you have high interest debt, you should not be investing. So if you have a credit card that charges you 20%, you should not be investing, because you can get maybe 8% in the stock market, but it does you no good to earn 8% if you're paying 20%. That's a negative 12% return. It doesn't make sense. And that's like trying to fill a bucket that has a hole in it. Get out of debt first, then start investing. Second point, emergency fund. You want to have some money set aside in a savings account for emergencies. This is money that you will not touch under any circumstances unless there's an emergency, right? Most financial advisors actually suggest 3 to 6 months of expenses. So for this, it's important. I would recommend watching my budgeting video where I talk about tracking your expenses and knowing how much you spend every month. And that way you can tell, okay, this is how much money I need in my emergency fund. 3 months, this is what I spend every month. I need 3 months of that, or 6 months, or whatever makes you feel comfortable. I have a very small emergency fund. I don't really keep a lot of cash. I like to have it invested because I can always sell some of my investments if I really have to. Next one, know your strengths. Don't invest in something you don't understand. I invest almost exclusively in stocks. I've been wanting to go into real estate, but it's not really where my knowledge lies, and so I've been kind of avoiding it until I know more. So do what you feel comfortable with. Do what you understand. Just because someone else made a bunch of money doing something does not mean that you can. They might have been a salesman. You might not be. I'm not really a salesman, and so I would never be able to do that kind of job. Keep it simple. Don't try to get rich quick on big moonshot investments. This also ties into knowing your strengths and educating yourself on anything you invest in. If something sounds too good to be true, chances are, it probably is not true. Like if somebody says, oh, we'll double your money in a week, or we'll multiply your money by 10 over, 1,000% in a year or something like that, it's crazy. I mean, high risk investments like stocks, or relatively high, moderately high risk investments like stocks return 8%. How are you going to get me 1,000% a year? That's just stupid. With that kind of return, you have to have that kind of risk. It's going to be outsized risk, right? There are plenty of people out there who are trying to cheat you, who are trying to relieve you of your money. I've been approached by more than a few people, I talk about money all the time, so they know I have savings, and so they come up to me and, they want me to invest in their business. But listen, if someone comes up to you looking for you to invest in some idea they have, chances are they already went to the bank, and the bank's already turned them down because it's a stupid business idea, right? So don't, be very careful when people come up to you asking you for investments. So All right, so next, keep in mind that there's a risk-reward trade-off. The greater the risk, the greater the reward, the greater the risk is going to be, because it's you only get the reward, the investment return, because you're putting your money at risk. If there's little risk, the investor doesn't need to be compensated as highly. That's why savings accounts give you so little money, because your money is basically risk-free. The chance of losing is so low. What you invest in really depends on your risk tolerance. Stocks are pretty risky, as you can see in that chart on the right up there. They go up and down, as I'm sure you know. A savings account isn't risky at all. The balance only goes up in dollar terms. Slower than stocks, but still just up, whereas bonds can go up or down, right? But over time, stocks go up. And that's why younger people should be invested mostly in stocks, because it's higher return, higher risk. Older people should also have some stocks for long-term growth, but a substantial portion of their portfolio should be in bonds or maybe cash, something with lower risk. It won't make you as much, but your money is safer. You can always keep your money in cash, but you won't really make anything, right? So there, as you can see at the bottom, there are potential losses and gains if you never try. That's keeping money in cash. You'll never make money. You'll never lose money, but you'll never make money, right? So take a look at this chart at the bottom center of the S&P 500. Now, the S&P 500 is an index. It's a list of the 500 biggest companies in America. And when they say the stock market, most of the time they're just referring to the S&P 500, because the returns that the S&P 500 have are so they influence the market so much that the returns of the market as a whole, all the stocks in the U.S. and the S&P 500, are roughly the same. So the S&P 500 is a stand-in for the whole U.S. stock market. And so take a look at this chart, right? It shows the positive days that the stock market had between 1926 and 2015, and it shows the negative days. And you'll notice right off the bat, there are more positive days than negative days, right? But it's still about 50-50. So that's kind of scary. One day your money goes up, the next day it goes down. So that's really kind of scary, right? But if you zoom out a little bit to the quarter, you'll notice that 2/3 of all quarters in between that time period went up, and only 1/3 went down. You zoom out to 1 year, 3/4 of all years, it went up, and 1/4 it went down. And if you zoom out to 5 years, 86% it went up. Zoom out to 10 years, 94%. All but 6% of 10-year periods in that time period went up. And if you go out all the way to 20 years, there hasn't been a single 20-year period in the history of the stock market, not just this period, just the history of the stock market, where people that kept their money invested and didn't panic and sell when it crashes ended up with less than they started. So there hasn't been a single period in history where if you put your money in the stock market at any point, 20 years later, you'd have more. And that includes the Great Depression's crash between 1929 and 1932, 1933, I think. I think it was 1933 when it bottomed out, but 89% it dropped. So you lost 9/10 of your money if you were invested, but it still recovered. And after 20 years, at any point, you'd have more money than you did at the beginning. And that's pretty crazy. So over the long run, stocks will make you a lot of money. That's the long run. In the short run, they can be super scary, as I'm sure you noticed in April of 2020, right? Or February to March or April, when the stock market crashed like 30% over a few days. It was scary. But people that stayed in, it quickly recovered. And that's not to say there won't be future crashes. There definitely will. But if you stay invested, you'll end up with money over time. And so that's why stocks are great for people with a long timeline, like younger people. Right? Now, there are several asset classes. There are several types of things you can invest in. The most prominent with the highest return is stocks, right? They get 7 to 10% a year on average after inflation. 7 to 10% before inflation. And after inflation, it's like 6 to 7% of real growth that stocks give you. And this is in an average year. You're never going to get consistent 10% returns. It's always going to be like 30%, and then like minus 15%. You know, it's always gonna be something like that. But over time, you'll end up with an average return of 6 to 7% after inflation. And so if you have, and stocks are good again if you have a long-term investing horizon, maybe a decade or longer, right? Bonds return 4 to 6%, maybe 3% after inflation. You know, real growth. They're good for the medium term. They're good maybe 3 to 7 years. They're good for stable income because bonds pay fixed interest and to the bondholders, right? And they're good as a hedge. Now, a hedge is like a protection, like in case something happens, sort of like an insurance, right? When you have bonds, they tend to offset some of the risk of stocks because they're negatively correlated. And what that means is that when stocks go up, bonds go down. And when, you know, stocks go down, bonds go up. So your return isn't as jerky, you know, isn't as shaky or sharp. It's more of a smoother thing. And you don't get as much returns because bonds give you less return, but it's still much smoother. The ride is much smoother, right? Next, we have like cash. Cash is really only good for the short term, like an emergency fund or if you're saving up for something. It loses value over time, you know, due to inflation. So you never really want to hang on to a lot of it unless, you know, it's your emergency fund you're saving. And that's about it. You know, there's gold, there's other precious metals. Those are great. Like if you're Jewish in 1939 and you're trying to flee Germany with some of your wealth, that's what gold is good for. You're trying to escape the country, basically. Gold is great as a hedge against inflation. It never really loses its value. Let's see. Precious metals tend to retain their value over time. A loaf of bread costs about the same amount in gold today, like this many grams or ounces of gold. You can buy a loaf of bread or a car or a house or whatever, as you could buy that same loaf of bread 100 years ago, 1,000 years ago for roughly the same amount of gold. And in another 1,000 years, you'll probably be able to buy that same loaf of bread with that same amount of gold. So gold, precious metals, they don't really lose value, but they also don't grow. You know, they don't really do anything with your money. And then there's like real estate and businesses, which it really varies. There's annuities, which help reduce risk. So you basically give people a sum of money at the beginning and they pay you like a fixed amount every month until you die or something like that. There's insurance, there's derivatives like options and futures. Those all help reduce risk. And then there's also derivatives like options and futures and speculative investments, which are used kind of to gamble. They're used to chase like high returns, like a moonshot, like Bitcoin or something like that. You know, those are speculative investments. Now, I'm going to briefly talk about stocks here. So stocks are essentially ownership portions of companies. They entitle you to part ownership of everything the company has. If you own 1% of all the shares, you own 1% of the whole company, and you're entitled to 1% of the company's profits. That's basically it. Bonds are basically IOUs, loans. A company or a government needs to raise funds for something. They want to build something, they want to do some infrastructure, or the company wants to expand or something like that. So they sell these bonds, these pieces of paper to investors that say, okay, if you give me $1,000, that's the face value of the bond, I will pay you 5% a year, that's the coupon, so like $50 a year, for that money, for the period of until maturity, until the bond is over. So for example, if I buy a 30-year bond, I give the government $1,000, they pay me $50 a year, and then at the end of the bond term, the 30 years, I return the bond to them, they give me my $1,000 back. That's essentially how a bond works. There's different ways to do it, but that's basically how it works. So it's a loan, that's all it is, and you get paid fixed interest for. Now gold, precious metals, again, they're great as hedging against inflation, but they don't earn you any money. Let me show you what I mean. So before 1965, 1964 and below, dimes and quarters, and maybe some other coins, but dimes were made of mostly silver, 90% silver. And gas in 1960 cost 30 cents a gallon, so you could just buy that with 3 silver dimes. Fast forward 60 years, and those same 3 dimes could be used to purchase a gallon of gas. the silver in those dimes are worth today, 60 years later, about $4, which incidentally is roughly the cost of a gallon of gas, right? So precious metals don't really lose value, but they don't really make you anything. So they're great if you need to retain the purchasing power and guard against inflation. So if you want to bury your money, precious metals is where it's at. If you want to grow your money, investments is where it's at, like bonds and stocks and businesses and real estate and all that kind of stuff. So here's a chart showing the returns of different asset classes. You'll notice first we have down there in blue, all the way at the bottom is CPI. That's the Consumer Price Index. That's basically inflation. Next you have gold. So it's just slightly above inflation. It's not really good. It's about the same. Then you have investment grade bonds. And so investment grade, all that means is just low risk. So low return, right? Then the purple is the S&P 500 index, which is the US stock market. And then the gray is REITs. That's real estate investment trusts. So real estate actually made more money, but it's a lot more, it's less passive than stocks could be. And so here's one showing what you would have today if you invested a dollar in today's money, but if you invested a dollar 200 years ago, the dollar would be worth almost $1 million. If you invest in stocks, it'd be worth about $1,500. If you invest in bonds, gold would be about $3. So again, it doesn't really grow, right? And the dollar would be worth pennies because you know, it loses value. So general investing advice: don't put all your eggs in one basket. You know, diversify. Don't put all your money in a single investment, a single stock, right? Don't invest or gamble any money you can't afford to lose. Do your own research. There is no safe get rich quick method, despite what many people will try to tell you because they want your money, right? Habits are greater than knowledge. You can understand all of this. You can have all this knowledge, but if you don't actually do something about it, if you don't actually start saving part of your income and investing it regularly and consistently, nothing's going to happen. You know, so habits are the most important part of investing. So yeah, and finally, I'd like to leave you with some good books I would recommend everyone read. And the first one is The Simple Path to Wealth. That's about investing. There's this one here, is Your Money or Your Life. What just happened? All right, so yeah, that's those books. So check them out. And yeah, so Your Money or Your Life, Total Money Makeover by Dave Ramsey. That is great for people who have debt, Rich Dad, Poor Dad. It kind of teaches you about investing, about how to think about real estate and assets and liabilities and stuff. The Millionaire Next Door is a great book to understand that millionaires aren't who you think they are. They aren't people who wear bling. They're people who are very modest. Like most millionaires are actually very modest with where they live, the cars they drive, the clothes they wear. And finally, Mr. Money Mustache. This is the person, he has a blog online. This is the person that first got me started on the path to financial independence. So I would recommend you read all those things, Google Mr. Money Mustache, do some reading, and get started investing. Thank you very much.